So, there's this idea floating around that sounds like an absolute dream for anyone who has a credit card. But what if that dream came with a pretty serious hidden cost? One that could mess with your wallet, your perks, and yeah, maybe even your next vacation. Let's get into it.
10%. Just lock that number in your head for a minute. It is the key to this entire story, and it could completely change the game for how your credit card works.
I mean, just think about that. What if, no matter what, your credit card interest rate could never, ever go above 10%? For anyone carrying a balance, that sounds amazing, right? Well, this isn't just some hypothetical question. It's a real proposal.
Okay, so here are the details. Former President Donald Trump has put this idea out there, a one-year cap on all credit card interest, setting the maximum at 10%. The whole point is to give cardholders some breathing room.
But here's the twist. While lower interest sounds great on the surface, there could be a huge unintended side effect. According to one expert, this move could actually threaten the entire world of points, miles, and cash back that we've all gotten so used to.
And that quote, wow, it really packs a punch. It comes from Tiffany Funk, who's a points and miles expert and co-founder of Point.me. And what she's arguing is that this simple-sounding cap could throw the whole perks system into, well, chaos.
So to really get what she's saying, we need to pop the hood on this whole rewards ecosystem. We've got to see where the money for all those perks actually comes from.
I mean, have you ever really stopped to think about it? Those points that get you a free flight, or that cash back you see on your statement, they don't just appear out of thin air. They're all part of this really intricate financial balancing act.
And this is the system right at the heart of the whole debate. Basically, the rewards ecosystem is a cycle. Banks make money from things like interest payments and fees, and then they turn around and use a chunk of that money to pay for the rewards that get us to sign up and stick with them.
So on one side of the scale, you have the bank's income. Interest payments from people carrying a balance, that's a huge piece of the pie. Then you've got annual fees and those little interchange fees they collect every single time you swipe your card. And on the other side, well, that's all the good stuff they give back to us. It's a two-way street, and it's all about balance. And Tiffany Funk really hits the nail on the head here. The rewards we love exist because of the money the banks bring in. So if you suddenly slash one of their biggest sources of income, interest, that whole system gets thrown way out of whack.
Okay, so you got to ask yourself, what would a bank actually do if its interest revenue got capped like that? Well, it would almost certainly set off a pretty predictable chain reaction. Think of it like a set of dominoes, right? The first one to fall is the interest rate cap, which hits their revenue hard. Then, the next domino, banks, like any business, are going to move fast to avoid losing money. That forces them to reevaluate the entire financial model of their credit cards. And what's the biggest, easiest lever for them to pull to save cash? You guessed it, the rewards programs.
So let's bring this home. What could this domino effect really mean for your wallet and for your travel plans? This is where it could get very real for millions of us.
Well, according to the experts, here's what we could be looking at. You might see fewer of those high-perk premium cards out there. The ones that are left, they could come with way higher annual fees. The rewards themselves, your points, your lounge access, they could all get watered down. And here's the really tough part. While the whole idea is to help people with debt, banks might just tighten their lending standards, which would make it even harder for folks with lower credit scores to get a card in the first place.
And, this doesn't just stop with your credit card statement. The ripple effects could spread out across the entire travel industry, especially to the airlines, since they're so deeply tied into all of these rewards programs.
So, are the airlines in trouble too? Well, the source suggests they might be a bit more insulated, at least in the beginning. But what does that really mean?
It seems airlines have a few layers of protection. For one, many have these long-term deals with banks that won't just vanish overnight. Plus, they make a ton of money selling miles directly to the banks in bulk. And their own loyalty programs? They're absolute cash cows.
But insulated doesn't mean immune. The prediction is that we'd see a significant rebalancing. And what that could mean for you is that the points you earn on your card might not transfer one-to-one to airline miles anymore. Or maybe you'd earn fewer points for every dollar you spend. The bottom line is, the value of your points could take a real hit. Now, it's super important to remember this wouldn't be like flipping a switch overnight. If a policy like this went into effect, it would take time. You'd have slow regulatory updates, then banks would have to roll out changes to their cards. We're talking about a gradual shift, not some sudden collapse of the system. And that really brings us to the heart of it all. This isn't a simple story of good versus bad. It's a trade-off. The proposal is designed to help one group of people, those really struggling with high-interest debt, but it might do that at the expense of another group,
the millions of us who pay our balances every month and really rely on that rewards ecosystem.
So that's the question we're left with. Is capping interest rates a clear win for consumers? Or does it come with a massive hidden cost that could take apart the world of points, miles, and rewards as we know it? It's a complicated question, and there's definitely no easy answer.